So you're new to trading the stock market. You're trying to decide, is the stock market for you or not? Well, there's a couple of different factors. You may have a very small amount of cash to work with. And if so, how do you trade the big stocks out there, the ones everybody's in love with? Google and Amazon and some of those guys. Well, fast forward, that's where options contracts come in. If you've not heard of options before, they could sound a little confusing, almost intimidating when you first start, but not to worry, because options can translate into one of my favorite words in the world, profit. Ka-ching. So if you like profits, smash the like button. And if you don't, hit the subscribe button. I may convince you otherwise anyway. Welcome, ladies and gentlemen. My name is Robert Roy, and I'm the founder of WealthBuildersHQ.com. In this video, we're going to go over what I call Options 101. Now, there are a lot of people out there that have created videos and trainings on options. The funny thing about it is most of them don't trade options. I've been training people for over 20 years how to trade options, well over 100,000 people that I've trained. If you really want to learn how options work, then you need to watch the rest of this video. The easiest way for people to understand options is to relate it to something that you already know, that you understand. Let's use a house. Now, you may not own a house, but you probably lived in one at some point in your life. Most people understand the basis of real estate, what it is and how it works. Let's say you want to buy a home. You're driving down the street and you see a sign, for sale by owner. You look at the house and you go, my goodness, that's exactly what I want. My spouse, my wife and I talked about this. That's the house. You knock on the door, the person lets you in, they walk you around the house, you're in love. You say, listen, I love the house. I don't even have to ask my wife. I could put a deposit on it right now. My wife would say, yes, this is everything we've asked for. Here's the thing I'm running into right now. I don't have the cash today, but I'm pretty confident I can get it. What I would like you to do is this. You're asking $400,000 for that home. I'm going to ask you to take the home off of the market for 30 days, and I will pay you $5,000 for that. If I decide to buy the house, I'll give you another $400,000. So in essence, you're selling it at $405,000. If I don't decide to buy the house in the next 30 days, the $5,000 is yours. So let's go through this scenario over a little bit. Let's say that you look in a newspaper on Sunday and you see that there's a new development being built. There's a golf course being built right behind that home. It says property values to skyrocket, increased by 50%. Wow, that means that house is worth $600,000. The original seller, the owner of the house, can he change the price on me? Absolutely not. We have a contract. That contract says I have the right, not the obligation, to buy the home at a set price, $400,000, on or before a set date, 30 days from now. Now, I'm going to find the money, aren't I? Think about it. If you've got a $400,000 home that's now worth $600,000, the bank's going to lend you the money. You'll find it somewhere to come up with the pay for that house. But let's say it's not a golf course. Let's say they build a state prison behind that. Property value is expected to drop 25%. So $400,000, now it's worth $300,000. What do? Well, you can't get your $5,000 back. You put that up as a contract. That was a fee you paid for them to give you the right and not the obligation. Well, by doing so, now the house value dropped. All you had at risk was the $5,000. If you had actually bought the home, you'd be $100,000 less in the value of the house. So by setting up and controlling that house and never having to purchase it, you have a better opportunity to do the things you need to. Maybe you never wanted to buy the house. Maybe your intention was to find somebody else to buy the house. Maybe you knew someone on the planning commission, or you went to a meeting and you heard a rumor that they were going to build that golf course behind that house. Now you go ahead, the house has the story come out, it's worth $600,000, according to the newspaper. You go find a contractor, a guy that you know that flips houses, and say, listen, I have this house. It's $400,000 I can buy it for. That's my contract. You could never get that contract because it's already done. I've got 2 weeks left in this contract. If you decide you want to buy this contract, you could buy the house for $400,000. Just pay me $10,000. Really? You'll sell it to me for $10,000? Yep. The house is yours. The contract is yours. He has to sell it to you. Would you do that? Well, if I'm a house flipper, you know I would do that. Of course I would. That's a great deal, right? $10,000, I originally spent $5,000. I put $5,000 in my pocket. I did nothing but connect the seller and now the new buyer together. So the analogy of the house shows us how an option works. Let's go back to the house numbers for a second. I have the right, not the obligation, to buy the house at a set price, $400,000, on or before a set date, expiration date, which is 30 days from now. When it comes to a stock and you have an option on that stock, whoever that stock may be, Apple, Microsoft, Google, it doesn't matter. You have the right, but not the obligation to buy the stock. And you would buy it at a set price on or before a set or a specific date, just like the house. Let's say you have a company, as an example, that is trading at $100. We'll call this company PFA. Now don't trade them, I made it up, it's plucked from air. Right? Plucked from air, PFA is trading at $100 a share. I want to buy PFA, I need $100 a share to buy the stock. Instead, I could buy an option and control the stock. Well, what does that mean? It means I have the right to buy the stock, not the obligation. Now, we set it a set price. What set price? Well, there are things called strike prices. They're the agreed upon price I buy the stock at. And we pick one of the strike prices out. Let's say I want to buy it at 90. So I have the $90 option. And that $90 option gives me the right, not the obligation, to buy the stock at 90 while it's trading at 100. Now, I may pay $10, $11, $12 for that option. And there are some things that will determine that, which we'll cover more in some later videos. For right now, just want you to get the understanding of what they are and how they work. So we can buy that option, let's say at $12, and I have the right to buy PFA stock at 100, right? Well, if PFA stock goes up 105, 110, 120, the value of my option goes up. So if the stock goes from 100 to 110, I may be able to sell that option that I bought for $12 for $20 or $22 a share. I never have to buy the stock. I never have to come up with the cash. All I came up with was the original $12 per share, and there are 100 shares in a contract is what an option controls. So you would have to come up with $100 per share times 100 shares would be $10,000, or I could come up with $1,200 and just buy the option instead. So there are two different types of options you can trade, calls and puts. There are some differences between the two, and it can be confusing to a new trader to try to remember the differences. So let me try to break it down easier the way that I did it with these cutesy things that I did for myself to try to remember the differences there. I want you to think of a phone conversation. Now, when I was in high school, there were no cell phones, text, email, none of that stuff. You had to actually call. You couldn't leave a voicemail. The person had to pick up to even know you called. And there was this girl that I really liked. Her name was Mary. And my friends kept pushing me, come on, call her. Call her. I finally did, right? So to call her, what did I do? To place the call, I pick the phone up. So for a call, I pick the phone up. When I buy a call, I want the stock to go up. So I pick the phone up and it's ringing. And she answers. My hands are sweaty. I'm nervous. I'm slurring my words. And when I said, hi, Mary, it's Rob, when she heard my voice, she hung up. So what did I do? I put the phone down. With the phone, I had to put the phone down. With a stock, if I want the stock to go down, I buy a put. So with a call, up, put, down. So it may sound silly, but I promise you some of you are going to be doing this. Next week, this will be you. Listen, if it works for you, awesome. If it doesn't, that's okay. It helps you to understand when I buy a call, I want the stock to go up. When I buy a put, I want the stock to go down. Think of the direction of a phone, and that's what you're looking for. So we just covered the basics of what an option is. In the future videos that we have coming up in the series, How to Become a Professional Options Trader, we're going to go through the different components of what options are and how they work, and working towards building you sustainable wealth, using options to do so. I hope this video helped you to understand what the basics of what options are. With that, make it a profitable day. Keep working towards the quest of becoming a great trader. Keep crushing it, and I will see you at the next video. Folks, thanks for watching the video. I hope you enjoyed it. If you did, please make sure to give it a thumbs up. Go ahead and click the subscribe button so you can follow along with all of our great content, and ring the bell so you never miss anything new that comes out. And folks, with that, down below, we've got a couple of other videos for you to choose from that you can watch from our materials.